Everyone's chasing the big robotics names right now. Tesla, NVIDIA, ABB, and Rockwell Automation. But the real money might be hiding in the stocks almost nobody's talking about. Today, I've got three tiny companies, all under $15 a share, that are quietly powering the robotics revolution from the inside. All right, one of them just posted a 122% earnings surprise, and another, top-rated Wall Street analysts believe could roughly double in the year ahead. And note that all three companies score in the top 3% of all the stocks we track in our proprietary quant ratings model. We'll break it all down in today's video. But first, I'm Steve Reitmeister. I've been investing for over 40 years, previously serving as editor-in-chief at Zacks.com. And today I'm a partner at WallStreetZen.com, where I help develop the quantitative rating system designed to help everyday investors make smarter decisions. And if you find value in videos like these, then hit that like button right now, because it helps me keep making more of them in the future. Let's properly set the stage as to why now is the good time to look into robotic stocks. All right, so when people talk about AI, they usually think about software. But the next phase of AI is moving out of the cloud and into the physical world, talking about things like autonomous drones, industrial automation, underwater robots, surgical robots, and smart factories. In other words, machines that can think and act in the real world. Shift requires a massive amount of infrastructure, because companies like NVIDIA, Tesla, and Google get most of the attention, then companies that actually supply the critical components often fly completely under the radar. And that's exactly where I look today. At WallStreetZen.com, we use our Zen rating system to identify the most attractive stocks that the market is too often neglecting. Note, the Zen Ratings analyzes stocks on 115 different factors proven to drive outperformance. Then we label them with an intuitive letter grades from A to F. Just like in school, A's get you on the honor roll and F's get you grounded. Okay. It also gives you insight on the key strengths and weaknesses with component grades across 7 key categories like value, growth, momentum, sentiment, safety, financials, and a proprietary AI factor that points to the most timely stocks. All the stocks I'm discussing today rank highly in this system, so let's get to them now. Starting off with stock number 1 in RF Industries with the symbol of RFIL. Now, the company operates in a much more physical, hardware-focused segment of technology stack. They manufacture RF connectors, cables, and custom cabling assemblies. That may not sound very exciting, but what they do is absolutely essential. If a system needs to transmit a signal reliably, it needs high-quality connectors and cabling. That includes systems used in defense electronics, 5G infrastructure, autonomous vehicles, and yes, industrial robotics. In harsh environments like military systems or factory automation, signal reliability is critical. That's exactly where RF Industries specializes. The company has been moving away from commodity cable sales and towards high-value integrated solutions. Instead of just selling individual connectors or cables, they're increasingly selling complete cabling assemblies and engineered solutions. That shift has helped drive margin expansion, and the quarterly financial results have started reflecting that welcome improvement. Now, recently the company reported a 25% increase in revenue that helped catapult them to a 122% earnings surprise. Now, this caught the market off guard, leading to a near tripling of shares from its 52-week low of $3.40. More importantly, our Zen rating system suggests that there is likely even more upside ahead. Now, RFIL carries a Zen rating of B, which implies a B recommendation, but overall, it's in the top 7% of all stocks in our model. Their sentiment grade is the most impressive ranking, which is in the top 5 of all 4,600 stocks we track. Yes, top 5, not top 5%. This means that insiders and institutional investors are showing strong confidence in the company and where it is headed. The momentum grade earns a B since the stock has been moving up nicely over the past year, but more importantly, growth also stands out as a key strength, with a B grade pointing to consistent growth across revenue, earnings, cash flow, EBITDA, and profit margins. On the risk side, the value grade is only a C, indicating that the recent jump in the stock price, the company isn't exceptionally cheap. It is also worth noting this is a very small company with a market cap around $125 million. When companies are that small, a single large contract can have a big impact, both positively and negatively. But when you boil it all down, the company is still a key supplier in several high-growth industries. That portends well for future growth and share price gains. Now, before we move on, if you're liking this video so far, please subscribe and tap the notification bell. That's the best way to see our next videos immediately after they get released. Now, Under the radar robotics stock number 2 is Orion Energy Systems with a symbol of OESX. Now, this company operates in a very different part of the robotics ecosystem. They focus on electrical infrastructure. Now, specifically, the company designs and installs smart LED lighting systems, Internet of Things enabled building controls, and commercial and industrial EV charging infrastructure. At first glance, that might not seem related to robotics, but if you look at where robotics is actually being deployed, places like automated warehouses, smart factories, and logistics centers, you start to see the connection. Those facilities require advanced power systems, connected centers, and automation-ready infrastructure. Orion provides exactly that. For example, the company has completed projects like retrofitting over 2,000 retail locations with smart lighting systems and installing 105 EV charging stations for the Boston public school system. Now, these systems don't just provide power. They also integrate Internet of Things sensors and automation capabilities, which means buildings can monitor energy usage, occupancy, and operational efficiency in real time. That same technology stack is increasingly being used inside robotics warehouses and automated industrial facilities. Plus, Orion is benefiting from several major macro tailwinds. First is the EV charging build-out. As electric vehicle adoption grows, which it certainly is, commercial and municipal charging infrastructure needs to expand quite quickly. Second is the energy efficiency mandates. Many governments and corporations are pushing aggressive sustainability targets, which often means replacing legacy lighting and electrical systems with smart, energy-efficient alternatives. Third is the broader electrification of industrial spaces, especially warehouses and logistics centers where automation and robotics are becoming standard. Now, some investors got wise to these trends, benefiting Orion. This helped shares rally last year from the $5.50 level to above $15 by year's end. Gladly, our data shows there is good reason for even more upside ahead. Now, right now, the company holds an overall A rating, which translates to a strong buy recommendation, and ranks in the top 3% of more than 4,600 stocks tracked by our Zen Ratings system. Now, growth is a clear standout, placing the company in the top 1% of all stocks. This bodes well for future beat and raise earnings reports, especially with recent positive comments from management. But again, there are risks here. One factor to watch is the company's recent filing of a $100 million shelf offering, which means they have the option to issue additional shares in the future. That could potentially lead to shareholder dilution. But overall, it is hard to ignore the strong marks from our Zen ratings along with the many growth tailwinds supporting these shares. This points to likely outperformance as we look ahead. But when you boil it all down, the company is still a key supplier in several high-growth industries that portends well for future growth and share price gains. Now, before we move on, if you're liking this video so far, please subscribe and tap the notification bell. That's the best way to see our next videos immediately after they get released. Now, let's move on to our third and final stock in Lantronix with the symbol LTRX. This is an extremely low-price stock trading under $5, and yet the Zen Ratings had these shares in the top 2% of all stock based upon its fundamental strength, meaning it probably won't be under $5 for long. Lantronix builds the communication layer that lets machines talk to each other. Think about what that means for modern robotic systems. You have sensors collecting data, processors analyzing, and different machines coordinating actions in real time. All that requires connectivity. Lantronix specializes in embedded modules, gateways, and out-of-band management systems that enable exactly that. Their technology connects things like industrial robots, autonomous vehicles, smart city infrastructure, medical devices, and defense systems. In other words, if machines need to send data back and forth, there's a good chance Lantronix technology is involved somewhere in that technology stack. They've been a trusted Qualcomm partner for over 15 years. Plus, they have a growing industrial Internet of Things division selling into automation, transportation, and defense. Those markets are exactly where robotics adoption is accelerating the most. As I already shared, the Zen Ratings is picking up what Lantronix is putting down. That shows up clearly in the A rating in the top 2% of all stocks we track. Their strongest component grades is for momentum, where they also score in the top 2% of all stocks. As Isaac Newton famously said, a body in motion stays in motion, and that is often as true for stocks as it is for physics. They are also in the top 20% of all stocks for both growth and financial strength. These are the most beneficial scores for finding stocks likely to have beat and raise earnings reports. That was certainly true for the most recent earnings report, where they had beat expectations by a whopping 45%. Lantronix is also one of the top companies in the communication equipment industry, which has a Zen industry rating of A. Now, I love seeing that. It's typically a very good idea to go for the best companies in the best industries, which is what we're doing here. On the Wall Street side of things, we see that both covering analysts rate LTRX as a buy. Most notable is Ryan Kuntz from Needham, who is a top 1% analyst based on his stock picking performance. Now, he just set a target price of $8.50, which indicates over 50% upside potential from today's level. Please be aware that many Wall Street analysts won't cover stocks under $10 per share. So once the company peaks above that level, it could draw in new coverage, which would act as a catalyst for even more share price gains. But there are some considerations to keep in mind. For one, the market cap here is only $245 million, which means trading volume can be thin and volatility can be a bit higher. Secondly, the company's revenue growth has been somewhat uneven historically, which can create lumpy earnings reports. However, their recent earnings improvements is encouraging. Plus, the more that robotics adoption accelerates, the greater the upside opportunity for Lantronix. Or to put it another way, not a bad idea to buy this under-the-radar robotics play before it is no longer so hidden away. Now consider what these three stocks represent together. You're not betting on a single robot company, you're betting on the infrastructure layer of robotics. That's the full stack: brains, signals, and power. And here's why that matters. In every major technological shift, whether it was with the internet, cloud computing, mobile, the biggest, most durable winners weren't always the folks who made the end products. They were often the companies selling the infrastructure that everyone else depends on. On top of that, all three of these companies trade for under $15 per share, receive strong Zen ratings, and have provided impressive results in recent earnings reports. All the above makes these stocks worthy of your attention right now. So, which of these stocks do you like the most, and why? I'm curious to hear your thoughts on these stocks or on the robotics investing theme in general. Just drop a comment below as I read them all. Now, if you like this video, then you will definitely want to check out another timely video featuring the top 10 stocks to buy now. Check it out.